Why is gold still sitting in central bank vaults, paying no yield, generating no cash flow, costing money to insure, when every modern asset framework says it is a relic? Central banks hold 36,000 tons of gold. It pays no interest. It earns no dividend. It sits in vaults. And in 2024, they bought more of it than in any year since 1967. Why? Gold pays nothing. That is the standard objection from a modern portfolio manager. A risk-free treasury yields 4 to 5%. An S&P 500 ETF dividends about 1.5%. Gold yields 0. Storage costs are non-trivial, roughly 0.4% per year for institutional custody. By any cash flow model, gold is an inferior asset. And yet, central bank gold reserves have grown for 15 consecutive years. In 2024, central banks added over 1,000 tons net. China, Poland, India, Turkey, Singapore leading. Russia repatriated nearly all of its reserves before 2022, which turned out to be useful. The freeze of Russia's dollar reserves by Western governments in February 2022 was the largest single advertisement for non-dollar reserves in modern history. The gold thesis is not yield. It is sovereign insurance. A dollar reserve held at the New York Fed is a US government promise. It can be frozen, sanctioned, or politically conditioned. A gold bar held in your own vault is a physical claim that requires no counterparty to honor it. The trade-off is yield for sovereignty. For most of the post-Bretton Woods era, the yield advantage of dollar reserves was so large that almost no one took the sovereignty trade. Since 2022, the calculation has flipped for any country that anticipates even a small probability of being on the wrong side of US policy. The corporate parallel is direct. Cash held at a bank can be frozen by a sanctions order, a court injunction, or a regulator. Cash held in physical form or in jurisdictions outside the political reach of your largest counterparty has different risk properties. Diversification of treasury custody is the institutional version of holding gold.